Imagine spitting into a small plastic tube. You seal it, you mail it off, and a few weeks later a website tells you where your ancestors came from, which version of a gene you carry, why coffee keeps you awake at night. 15 million people did exactly that. They handed a company the most personal data a human being owns. The code written inside every cell. The company that collected it was once worth $6 billion. It threw celebrity spit parties. It promised to rewrite medicine. And then, in the spring of 2025, it filed for bankruptcy. And the spit those 15 million people had mailed in became an asset on a balance sheet to be auctioned to the highest bidder. This is the story of how one breach buried a $6 billion empire, and what the people left holding the debt saw before anyone else did. The idea started in Silicon Valley in 2006. Anne Wojcicki, a Wall Street healthcare analyst, founded the company with Linda Avey and Paul Kusenza, and named it after biology class. We each carry 23 pairs of chromosomes, so the company became 23andMe. The pitch was radical for its time. There was no need for a doctor, a hospital, or a prescription. Just saliva. The first kit launched in 2007 at $999, and a year later Time magazine named the saliva test its invention of the year. It was a genuinely good product. For the first time, ordinary people could read parts of their own genetic code from their kitchen table. Google was an early backer. Customers shared results at dinner parties, and the company leaned in and threw actual spit parties, where guests filled tubes between cocktails. The brand became shorthand for a whole category. But there was a quiet problem buried in the business model, and it was visible from the very beginning. A genetics test is something a person takes once. You learn where your great-grandparents came from. You find out you process caffeine slowly, and then you are done. There is no reason to come back next month. Curiosity, it turned out, was bought only once. The company sold millions of kits. It just could not sell them twice to the same person. To fix the problem of a product people only buy once, the company needed a second act, and it found one in an idea that sounded like alchemy. The 15 million people who spit into those tubes were not just customers. Together they were the largest privately held library of human genetics on Earth. And drug companies will pay enormous sums to mine a library like that. In 2018, the pharmaceutical giant GlaxoSmithKline paid $300 million for exclusive access to the database to hunt for new medicines hidden in the DNA of millions of strangers. The data, not the kit, was the real product. That was the story Wall Street fell in love with. In 2021, at the height of the boom in blank check mergers, the company went public through a shell company backed by the billionaire Richard Branson. The deal valued it at $3.5 billion. Within months, the stock ran higher, and the company was briefly worth around $6 billion. A spit kit had become a $6 billion bet on the future of medicine. The market was buying a story, not a business. And the story depended on one thing staying true forever: that millions of strangers would keep trusting the company with their most intimate data. If you are still watching, you are exactly who this channel is for. Bondholder is new. We are building this from scratch, telling the stories of corporate collapse from the perspective of the people who saw it coming. The creditors. If that is the kind of story you want more of, hit subscribe. You do not just stay in the loop for the next company that mistakes a story for a business. You help us keep making these. Thank you. But the spit in the tube was always worth more than the company collecting it. Strip away the $6 billion valuation, and the business underneath was burning cash. The company had sold tens of millions of kits, but the people who bought them had no reason to buy again. And a competitor, Ancestry DNA, was fighting for the same shrinking pool of first-time buyers. Revenue from kits flattened, then fell. Growth is not the same as revenue. There were two plans to escape that trap, and both failed. The first plan was the data, but mining genetics for new drugs is slow, expensive, and uncertain. The partnership with GlaxoSmithKline ran for years and produced no blockbuster medicine. When the exclusive deal ended, The drug makers stopped co-developing new programs and paid only a small fraction of the original sum for a limited license. The company had also built its own drug division, spending heavily to invent therapies from scratch, and by late 2024, it shut that division down and cut roughly 40% of its staff. The second plan was to become a healthcare company. Flush with cash from going public, the company had gone shopping, and in late 2021, it paid $400 million for a telehealth startup called Lemonaid Health, betting it could turn a genetics test into a primary care business. It could not. In bankruptcy, that same telehealth arm would sell for $10 million. The second act never arrived. And then came the part the company could not spin. In 2023, hackers spent 5 months quietly working their way into customer accounts, logging in with passwords people had reused from other websites, then harvesting the profiles of relatives linked through the site's family matching feature. By the time anyone noticed, they had the personal data of nearly 7 million people. The breach was not random. Attackers built and sold lists that singled people out by ancestry, targeting users of Ashkenazi Jewish and Chinese descent specifically. The stolen profiles were offered for sale on the dark web. The one thing the company had promised to protect, the thing that made the data valuable in the first place, was trust. And trust, once spilled, does not go back in the tube. Stock, already weak, began its final slide. Management settled a lawsuit over the breach for $30 million. Then, in the autumn of 2024, nearly every independent director on the board resigned at once. Here is where the creditor's view of this collapse separates from everyone else's. This company never had the kind of debt that usually defines these stories. There were no bonds trading at distressed prices, no syndicate of senior lenders circling. When it finally filed for Chapter 11 in the spring of 2025, it listed about $277 million in assets against $215 million in liabilities. On paper, it was not even deeply insolvent. So who were the creditors? Two groups, and neither one looked like Wall Street. The first was a single lender, JMB Capital Partners, which put up $35 million of fresh money to keep the lights on through bankruptcy. That loan sat at the very top of the stack. First in line, secured against everything. The second group never signed a loan agreement at all. They were the nearly 7 million people whose data was stolen, turned by the breach and the courts into the single largest body of creditors in the case. More than 250,000 claims were eventually filed against the estate. And here is what the people closest to the money understood that the shareholders did not. The smart money did not have to guess what the library was worth, because a drug maker had already named the price years earlier. The equity was a story. The data was collateral. Months before the public shareholders accepted that the company was finished, the people who follow the debt were already valuing one thing and one thing only. A company with no recurring revenue and a wrecked reputation had exactly one asset anyone would pay real money for: the genetic library of 15 million people. By the time the public shareholders were panicking, the only question that mattered was already on the table. Who would end up owning the spit? The bankruptcy became an auction for the database, and it moved fast. To stay listed on the NASDAQ, the company had already been forced into a reverse stock split, collapsing 20 old shares into one to push the price back above $1. A reverse split is a confession. It says the market has stopped believing. In May, a large biotechnology company, Regeneron, won the auction with a bid of $256 million. It looked finished, then it reopened. Anne Wojcicki, the founder, who had resigned as chief executive the day the company filed, came back, not as a buyer for the company, but through a new nonprofit she had created. Her nonprofit bid $305 million. It outbid the biotech. In July, a federal appeals court cleared the way, and the sale closed. From a distance, the shape of it is almost too clean. A founder builds a company. It reaches $6 billion. It collects the DNA of 15 million people. It cannot make money, it loses their data. It goes bankrupt, and the same founder buys back the one thing of value, the data itself, for $305 million. That is a nickel on every dollar the company was once worth. The customers who supplied the asset were never asked. Across the country, state officials were urging those customers to delete their accounts and demand their samples be destroyed before anyone could buy them. A court had appointed a privacy overseer just to watch where the data went. More than 24 state attorneys general objected to millions of genetic profiles changing hands in a courtroom. The judge let the sale proceed. The data had an owner before the people who created it could stop it. The spit was spoken for. The product was never the test. The product was always the people who took it. So what does this collapse actually prove? Not simply that a company ran out of money. It proves what happens when the asset on the balance sheet is other people. 23andMe was never really in the business of telling you about your ancestry. That was the free sample. The business was assembling a genetic library and renting it out to drug makers and in the end to a bankruptcy auction. The model only works while the people inside the library keep believing it is safe. Break that trust once and the whole thing reprices toward nothing. This was not unique to genetics. It was the blank check bubble in miniature, the same era that sent Richard Branson's own space ventures from celebrated to below $1 a share. A merger with a shell company let a money-losing business skip the scrutiny of a normal listing, borrow a celebrity's shine, and reach a valuation its revenue never came close to supporting. Ancestry DNA hit the same wall of one-time buyers and was quietly absorbed by a private equity firm. The pattern repeats anywhere the customer is not the buyer, but the inventory. The difference is what 23andMe was carrying when it fell. Because here is the part that does not get discharged in bankruptcy. A court can wipe out a company's debts. It can cancel its stock. It cannot unsequence a genome. The 15 million people who mailed in their spit did not get their data back when the company died. It simply changed owners. Most collapses leave behind empty offices and angry shareholders. This one left behind 15 million genetic profiles, still sitting in a database, still belonging to someone. So where did everyone land? It comes down to priority. The order creditors live and die by. The $35 million rescue loan, first in line, was repaid from the sale. The breach victims, the involuntary creditors, were folded into a settlement worth up to $62 million, carved out of the proceeds. Spread across millions of people, the fund came to very little for any one of them. Even as the database their spit had built changed hands for $305 million, secured and priority claims were paid in full. The genetic library itself went to the founder's nonprofit, which now runs the company, renamed as a nonprofit. And the equity? The shareholders who bought into the $6 billion dream on the open market were last in line, where equity always sits. When the plan was confirmed at the end of 2025, their common stock was simply canceled. Roughly 27 million shares, wiped to nothing, leaving holders a residual claim worth, in all likelihood, zero. The people who saw it coming first did not see a fraud or a villain. They saw arithmetic. A company whose only real asset was its customers, run by people who could not turn that asset into a profit, owing a debt it could never repay to the very customers who had built it. The creditors did not need a press release. They could read the stack. The brand has a new owner and a new name. The stock is gone. But the spit is still in the tube. And the tube still belongs to someone.